The secret, in my opinion, to making huge amounts of money in dividend stocks is finding those particular stocks that comprise two qualities. Those two qualities that I'm talking about are bargain basement valuations combined with huge prospects for growth, for revenue growth, and for earnings growth. When you find one of those stocks that comprises two of those particular qualities at the same time, it's possible to make a lot of money in dividend investing. And I've proven this on my channel time and time again throughout the years. Today, I want to share a dividend stock pick with all of you. This is a Canadian dividend stock, and so I'm so excited. Shout out to all my Canadian subscribers. This is a company called COUCHE-TARD. You've probably heard of them, however, from their Circle K brand of convenience stores. I'm going to go through COUCHE-TARD in great detail today. I'm going to go through a financial analysis. I'm going to summarize the pros and cons with this investment, and most importantly, I'm going to go into great depth in their 10K and 10Q, their annual report and their quarterly report. I have a lot to go through today. Before I get started, don't forget to subscribe. I have so much more analysis on the way. You don't want to miss out. Also, don't forget to smash that like button. If you enjoy my analyses here on YouTube, by smashing the like button, it really helps me out. It helps my videos reach more people. Get ready, everyone, for a really exciting Canadian stock pick analysis in today's dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, before we even get started, I have two housekeeping items. First and foremost, shout out to Brandon Beavis. Brandon Beavis, I will link to his channel in the pinned comment below. He is my favorite Canadian dividend stock investor, Canadian investor as well. He talks about all kinds of Canadian stocks. If you want to check him out, he's in my pinned comment below. And I'd be curious, Brandon, if you're watching, what do you think about this stock? What do you think about COUCHE-TARD? I'd be really interested to hear what you think. And the other one is a funny story. What was so interesting is this year, a lot of you know that I am focused on high growth stocks that pay dividends, by the way. And so I've done really well with that strategy so far this year. It's been a good year. And when I was asking the community on YouTube, hey, what do you guys think are good high growth dividend stocks? Someone put in the comments like, Ian, have you heard of COUCHE-TARD? And when I saw that comment, I'm like, wait, is this guy trying to make fun of me? Is like calling me COUCHE-TARD or something? Is he trying to like call me a name or something? And then I look it up and lo and behold, it's this amazing company that I'm going to cover in the video today. And so just some humor for all of you as we get started. Anyway, I want to share some metrics on the screen. So check it out right now. As I always do, I want to just start with a few overview metrics. This thing is trading right now at 33.73. And by the way, I am looking at the ADR ANCUF ticker. This is the one that I can buy here in the United States. This is the Class B shares. I'd actually probably buy the Class A shares if I do initiate a position, but the Class B has more info on it when I was digging the internet for these metrics, and so that's why I use Class B shares. There are more Class B shares outstanding as well. Class B are non-voting, Class A are voting, and on the Class B shares, it's trading at 33.73. The trailing 12-month EPS is $2.44, and so that places the PE at a 13.82. This is what I was talking about, bargain basement valuation on a trailing 12 months basis. It's at a 13.82. The dividend is really low, and so on an annual basis, it's 28 cents. On a quarterly basis, it comes out to just under 7 cents. And so the fact of the matter is this dividend yield is only 0.82%, and that's a payout ratio of 11%. So this is lower than the dividends that I typically target. However, there's opportunity for long-term yield on cost here. Certainly, this is a long-term growth investment, not a short-term cash flow investment. Let's keep going. Check it out on the screen right now. And so this company sports a market cap of $36.5 billion, and the stock has performed really well over the long run. Now, what's so interesting to keep in mind, over the 10-year period, this thing was trading at $10.26 back in 2011. And then in 2021, it's trading at $33.73. However, I really think that $33.73 is misleading. And the reason for that is you can see on the chart here that it just basically drops in half in 2019 in 1 day's time. Well, the reason for that, quite frankly, is this stock split. And I don't think that the data providers in the United States that are actually representing this stock are representing it properly. So what I am doing to account for the split and to really understand what the performance has been over the last 10 years is I take the 2011 price per share of $10.26, and then I take 2021 and I just double it to account that, hey, it dropped there because the chart wasn't updated. It wasn't right sized, if you will, for the split. Anyway, the 10-year compound annual growth rate has been 20% growth per year on average. That's what I'm talking about. This is a growth company. And so in terms of the dividend, it's pretty impressive. If I look at the 10-year compound annual growth rate for the dividend, it's actually about 18%. Now, over the last 5 years, it's only grown the dividend by 5% on average per year. And so it's slowed down just a bit. But one of the things I just want to share on the screen right now is that when you look at stock charts, especially for stocks that are not US based, sometimes there are anomalies and you really have to dig into things to try to figure out, well, why does the chart look so weird? And the best of my knowledge, again, is in 2019 that it didn't actually drop. It's just because the split threw things off in the charting. And so that is the overview of Couche-Tard really quickly. And what I love about it, again, low PE combined with high growth. And the high growth is represented in the share price and in the dividend growth, even though the starting yield is really small. Now what I want to do next is I just want to get into an overview of their business, some of the pros and cons, and then I'm going to dig into the numbers in great detail. So check it out on the screen right now. And so what I want to share first is this is a convenience store company. And the brands that they have are Couche-Tard, Circle K, and Ingos. The one that you're probably most familiar with is Circle K. Couche-Tard is their main brand that they have in Quebec, in Montreal area, where they are based out of as a company. And so this company operates 14,227 stores throughout the world. It is a global company. There's two classes of shares for U.S. investors. The one I am analyzing today is the Class B, although that's because there's more data. That's the one I picked for my analysis. If I were to move forward with a position in this company, and I might, I will go ahead and buy the Class A shares because they have voting rights. And I talked about the stock chart. This is a 40-year-old company, so there's a lot of history there. And while the majority of their business is in the United States, their Quebec heritage gives them a different perspective. I'm going to talk about, again, their distribution of stores across the world later. But basically, the United States is their hub of activity. But what I would say is this is a clever business. It's a creative business. They're making certain types of moves, honestly, that I don't see day to day from a U.S. business. And so what I'm saying is when people ask me, Ian, do you diversify globally? Well, yes, I do. I own a variety of global companies, and I do that two ways. I buy stocks based out of the US that have sales and exposure internationally, and I buy pure plays that are basically based overseas. The reason I like this company is because it's based in Quebec. They're taking a different approach than a lot of US companies, and that really resonates with me. I'm a global investor. I really like that. Let's keep going. Check it out on the screen right now. And so what I would also say is if someone were to invest in this from the US, you just have to be careful of foreign tax withholding. With Canadian companies, there is no tax treaty with the US government. And so basically, foreign taxes will be withheld on dividends, although the dividends are really small here, but you can claim those back as a credit on your tax return. And so just speak with a qualified tax advisor about that. Now, in terms of the pros, what do I like so much about this company? What are some of the things? Usually I put this at the end of the video, but I want to plant these seeds early today so that you can think about the high level before I get into the details. So check it out on the screen right now. What are the pros? Why do I love this thing so much? Well, what I like is it's a land play. This is a real estate company that has locked up some really amazing land, but it's not an obvious real estate play. It's not a real estate investment trust, if you will. It falls into a similar bucket of companies that I own, such as McDonald's and Cedar Fair. These are, again, not real estate investment trusts, but they're real estate companies. This is a land play like those, and I love that about this. This is a growth stock at a reasonable price. Look at this thing. They're saying they want to double their business over the next 5 years, and this is a year of growth for me. I bought a company, HOUSEKEEPING Inc. I'm already up 18.68%, and I haven't even held it for 1 year. Growth stocks that pay dividends, that's a focus of mine right now. And this falls into my strategic priority, and this is a growth stock at a really reasonable value, even better value than HOUSEKEEPING Inc. I really like that they have cannabis exposure. They purchased a company called Fire and Flower Dispensary, and they also have a deal with Canopy, and they expect to be one of the foremost leaders, if the foremost leader, in actually selling cannabis in greater North America. And so they can do that through their retail stores. It's really exciting to understand more about that, and I will get into that in the video today. And they're thinking out of the box, as I said. Quebec company, really thinking cleverly. They have a secret sauce at this company, that is for sure. And so in terms of cons, I would say there is a huge reliance on gasoline sales. And so we all know this world is moving more towards electric vehicles, but they own convenience stores, and as part of those convenience stores, they have gas stations. It's all the same, gas station convenience stores combined. And basically, what's going to happen with gas stations? Over the long run, they're going to have to be turned into EV charging stations. Now, thankfully, they have some really, really amazing experience with EV charging stations overseas that I will get to in the video today. And so I think they are ready to pivot, and they will pivot successfully. I would say in terms of another con, there's probably some overlap here with my oil portfolio, and I'm not excited about oil right now. And so being a gas station oriented company, I look at that as a con, but I also think this is a company that is so much beyond the gas stations. It's so much beyond that. You'll see throughout the video today, it's a really clever company. And so even though it does overlap a bit with what I'm doing in oil, I really like this. I really like this company. Let's keep going. Check it out on the screen right now. And so also what I would say is, in terms of cons, it has a low current dividend yield. There's no doubt about this. I'm not going to be paying any kind of cash flow. I'm not going to be using cash flow from this company to pay any kind of bills in the short run. This is a company that is paying a dividend yield right now of 0.82%, and so it is just not enough. It's not enough really to get me anywhere, but over the long run, if they continue to grow their dividend very aggressively as they have been, there's huge opportunity for high dividend yield on cost. And so with that, I want to move into the next part of the video today, where I go through a sequence of slides that I cherry-picked from their quarterly report, from their annual report, and from elsewhere to better illustrate this really clever Canadian dividend stock pick. So let's keep going. Check it out on the screen right now. All right, and the first table that I'm showing is basically a summary from their recent quarterly report. It's the third quarter of their fiscal year, and so they're 40 weeks into the year. Period ended January 31st, 2021, and it shows the different types of stores that they have. They have 14,227 total stores, but they have company-operated stores. They have CODO, and CODO, what I really would equate it to is the refranchising efforts at McDonald's. What they basically do is they own the land and they're the landlord, but they have someone else operating the store. I love that business model. They also have DODO, where they've basically contracted to provide fuel through supply contracts. I don't know, I'm not quite as excited about that. And then they have franchise and other affiliated. And so the ones I'm most excited about are the first two buckets. Thankfully, those comprise the lion's share of what they're doing, company operated and CODO. So that's a quick overview of what they're doing with their stores. Let's keep going. Check it out on the screen right now. And so the next thing to keep in mind is from their recent quarterly report. This is some of the selected financial data. Now, what I went ahead and did, and it might be a little difficult to see on your screen, but throughout the slides today, I used these little green marks. I didn't put it there to be a minus sign. I actually put that green mark there to highlight certain numbers that I want to draw attention to. And one thing to keep in mind is that revenues over the first 3 quarters of their fiscal year are down, and they're down 24%. And that is because, obviously, of fuel. Fuel sales are way down, although their retail sales are doing all right. And so if we keep going down, though, gross profit, wait a minute, gross profit is up 5.6%. It's up 5.6%, even though fuel sales are so much down. And when you drop all the way to the bottom, the third green line, what you start seeing is that net earnings attributable to shareholders are up 20.5%. And so this is a company that even in a horrible environment where less people are driving around, they have found a way to basically make their business work. And the way they've made it work is basically because the price of gas is so low. They found ways to source gas for their gas stations where their margins have just expanded. Now, if I were to point out a con or a potential red flag is, will that last forever? We already know that the price of gas is increasing. And so with that, are they going to be able to hold those same levels of margins with their customers as when gas was really low? I don't know. And so if margins get squeezed on fuel and they're selling less fuel, you could see a scenario where their gross profit and their earnings go down. But for now, gross profit and earnings are up because they've managed that delicate fuel situation really, really well. What I would also say from a retail standpoint is they're doing really well on retail. During the pandemic, for example, they have found that a lot of customers are coming into the convenience store more frequently. Same-store sales are really strong. I think they're up when I was looking at same-store sales. And it seems on the back end, from an operations standpoint, they're keeping their costs under control, so their margins overall at the business are really strong. Net earnings are really strong. And so this is a company that has maneuvered through the pandemic really well. They have a secret sauce, as I said, and the thing that attracts me to this company is it's a hidden gem. It's a gem out there that I never even knew was a public company, but it seems like they have a lot going for them. And so I really thank the subscriber, by the way, that pointed this thing out. Let's keep going. Check it out on the screen right now. And so the next slide that I want to cover shows basically some of their margins. And what I really wanted to highlight that I circle here is the margins are way up, as I said, on road transportation fuel. So gross margins there are up like in the 30% range year over year, 34% United States, 30.8% Europe, 31% Canada. And so basically at this company right now, the margins are doing so well on fuel. Will that last? I don't know. There's certainly some risk there. Let's keep going. Check it out on the screen right now. And so the next slide that I want to show dives into the cash flow a little bit. I don't need to spend too much time here, but what I really wanted to point out is that the net cash provided from operating activities in their recent quarterly report, it's up year over year despite the pandemic. However, net cash used in investing activities is they're subtracting out more money there. And one of the big things that I wanted to point out was purchase of property and equipment. It's strong. It's strong both years, quite frankly. And they have business acquisitions too, which are really strong this last year. But what I'm trying to say here is capital expenditures are real. Any company, when you look at GAAP earnings, generally accepted accounting principles, which applies to US-based companies, that's how I'm used to looking at things. All of these companies need to make investments in infrastructure. They need to upgrade their stores. They need to upgrade their property, their plants, their equipment. That costs money, but it doesn't factor into net earnings. And so it's really important to look at the statement of cash flows to pick out those numbers and to understand after those numbers, are they still making money? Let's keep going. Check it out on the screen right now. This is going to just be another one that shows CapEx is real. Again, it shows that during the first 3 quarters of 2021, net investments in property and equipment, intangible assets, and other assets amounted to $746 million. And business acquisitions for $27 million. And so what I'm just trying to say here is CapEx is real. When we evaluate companies, we cannot just look at net earnings. We have to look at cash flows. We have to incorporate CapEx. Now, thankfully, from an overall cash flow standpoint, the company is strong. From an overall net earnings standpoint, this company is strong. I like what I'm seeing. Let's keep going. Check it out on the screen right now. The main thing I'm trying to show here is they show their outlook. And on the outlook, basically, they show, hey, what are we going to do? They're trying to do a lot of things. They're trying to improve customer experience. I love how this company is maniacally focused on customer experience, very similar to Amazon, for example. And I think that's what served them so well. It's an old school, I would say, real estate-oriented company, but they take tech-oriented approaches, Silicon Valley best practices, and it's served them really, really well. I also like that they're integrating their activities in Asia, and they're starting to expand into Asia. They acquired Circle K Hong Kong, for example, and I think they're really setting themselves up there for a lot of growth. And it says these actions bring us closer to reaching our 5-year ambition of doubling the business. This company is already $36 some odd billion market cap. They want to double their business. That's so exciting. It's a growth company and a value company. Let's keep going. Check it out on the screen right now. And so the next one that I want to show is the strong balance sheet. And so on their balance sheet, one of the things I highlight in green, the first thing under assets is property and equipment is the biggest single line item under all of the assets, and it's up year over year. It's 10.7 billion. And by the way, I'm pulling all of this from their deck. This, to my understanding, these numbers are in Canadian dollars, to my understanding. And so I really like the assets. It's a real estate company. It's 10.7 billion because they own a lot of land. They own a lot of stores. It's great real estate. The other thing I really like about this company is they're really good about managing their liabilities. And so year over year, liabilities are down, and most importantly, year over year, long-term debt, as I highlight, is down 7.5 billion down to 6.2 billion. In the middle of a global pandemic, with all this uncertainty, are they going out and taking on more long-term debt? No, they're not. They're not doing it like so many other companies. They're actually paying down debt. I really like that about Couche-Tard. This is a really, really awesome thing to see on the balance sheet. And so, strong balance sheet. Let's keep going. Check it out on the screen right now. And so, the next one is the actually, so now I'm done basically with the quarterly report. I'm going to get into just some news. This one comes from the conveniencestorenews.com website, and it shows up that Circle K is charged up for electric vehicle adoption. And so one of the things I highlight here is just for the last 3 years in Norway, it's been a home to the company's global EV lab, and they've dedicated a team to it there, and they've basically become the leader in Norway as it pertains to electric vehicles and electrical vehicle charging. And so Circle K is now going to bring these learnings to North America. It plans to be ready as an EV adoption grows among motorists in North America. And so you'd think, hey, one of the risk factors with this company is, are they behind times? Are they going to fall behind as it pertains to EVs? It actually seems, based on their Norway experience, they're ahead of the times. And if what worked for them in Norway works for them in North America, they're going to pivot their business as we move from oil to EV really well. Let's keep going. Check it out on the screen right now. And so next one I want to share is just they made a bid for Carrefour. This is a company that is a French company that owns, I believe, grocery stores in Europe and abroad. And basically the company turned down their bid. I think the French regulators said no. The government said we're not going to allow that to happen. And the reason for that is I think they were basically saying quality control of their food. I'm not so sure why they would say that, but basically they turned it down. But the reason I'm showing this is Couche-Tard is not just about their convenience stores. They're not just about their traditional Circle K brand. They are making inroads into other related tangential industries, if you will. And that's where I think they're going to see a lot of their growth. And so even though they were turned down, I like them going up to the plate to bat. I like seeing them make these types of offers, and I'm sure they'll continue to do this and they'll win some of them. And so let's keep going. Check it out on the screen now. And so next thing I want to do is talk about network growth. And so one of the things that was said in this press release, in this article, again, this is from the conveniencestorenews.com website, is COUCHE-TARD'S biggest international move was closing of its acquisition of Circle K Hong Kong. That's a network of 341 company-operated stores and 32 franchise stores in Macau. And this acquisition marks a significant milestone, and it's a platform where they're going to grow and regionally in Asia. I am really excited to see that because obviously that's where so much growth is in our world right now, is in China and in Asia. And so I think there's a lot of opportunity there for them. It's nice to see them close out that acquisition. Let's keep going. Check it out on the screen right now. And so this one just gives a visual representation of where their stores are globally. And this actually is a graphic that came from their annual report. So I'm in the annual report right now. And so what's interesting here is, I guess, the blue marks really where they have representation, and it's grayed out where they don't have representation. And so obviously there's a lot of room to grow, but it also shows why they're so kind of concentrated in the US and North America as well. And so, yeah, it's a global company. It's a company based out of Canada, but they have a lot of dependence on the United States. I'd like to see them get into more different continents, like Australia, perhaps, maybe Africa, maybe South America. There's a lot of opportunities in, it looks like in Europe, there's a lot more opportunities. And so hopefully this is the kind of company that can continue to grow. You know, I come to think of it, there's this company, Pret. I feel like Pret, that kind of quick convenience, like healthy food eatery that exists in Europe and does so well in London, that would be kind of a really interesting business. If you think about Couche-Tard, could they merge or work together with a company like that, or even try to compete with them? That would be interesting for them to make more inroads in Europe. But I'm just speculating here, just an idea that came to my mind. Let's keep going. Check it out on the screen right now. And so the next thing I want to do is I want to go through another, I guess, this is just text actually from their annual report, so I'm not even getting into the numbers yet, but this is just from their annual report from 2020 fiscal year. And basically what it talks about here is what they're doing technologically speaking, and they're building loyalty through personalized offers. And basically they're able to track their customers, and they're able to offer up opportunities to them based on their purchase histories. And that's a dynamic thing that they're doing. It's state of the art. They're also making strides, quite frankly, in state of the art dynamic pricing as well. And so I see a lot of similar trends here, by the way, that I've seen at McDonald's on the technology side. And sometimes when we invest, we think, hey, to invest in a tech company, it has to be a pure play internet tech company. Not true. Even traditional companies, real estate companies like this one, have technology focus, and I think that's what served them so well so far. Let's keep going. Check it out on the screen right now. And so the next thing is they talk about their innovation, and they continue to talk about innovation. And two things come to mind here. I like that they're working with gamification. Basically, in Europe, they have some mobile-centric games and promotions that are basically enticing customers to stay loyal to the brand and to make more purchases. The other thing that I like is, based on the pandemic, they started running out a pilot of actually in-home delivery of food and different items from their convenience store. I'm sure that's what the lady on the screen is wearing, that mask. It looks like she's making a delivery, perhaps to that man in the other picture who doesn't feel comfortable leaving his home because of the pandemic. I thought that was really interesting because these days with things like Amazon Prime, for example, and Amazon Prime now, you can get food basically the same day from Amazon Prime. And so it seems like that with the Circle K app, for example, perhaps it could come even quicker than with Amazon, especially because the Circle K stores, if it's really located close to someone. And so I thought that's really good that they're going that route. because if they don't go that route, they may fall behind because so many consumers, they don't want to leave their home. They just want it to come to them. Let's keep going. Check it out on the screen right now. And so the next thing is they talk about EVs. Again, this is just in Norway. They've had a lot of success, their EVs. And it just says, when you reach the level of penetration we have in Norway with EVs, this can be a major traffic driver and a competitive advantage. They're being there before the competition. They're capturing EV drivers that could instead go to other places. And so they're first mover in Norway in EVs. I hope they can be first mover in North America with EV charging stations as well. Let's keep going. Check it out on the screen. And so next thing is they're basically building on their track record as a responsible retailer. And so, oh man, this is the slide I've been waiting for. Thug life on the reel. This is what I do. They take it seriously. Consumers want it. They love it. Let's do it. And so basically, we have taken the same responsible approach with CBD products in jurisdictions where it has been legalized. And we intend to be the North American market leader in this segment. Let me repeat, Thug Life investors who are watching, I own them all the SIN stocks. I love it. It makes my day. It's my right to own SIN stocks. And so COUCHE-TARD, they're doing it in a responsible manner. If you want to go, it's been legalized. You go to your Circle K. They are going to help you out. Let's keep going. Check it out on the screen right now. And it goes on to say, we are also exploring the cannabis opportunity in Canada as it both fits in with our work on innovating the customer experience and our historical experience with age-restricted products, so on and so forth. And it says we invested CA $26 million in Fire and Flower Holdings. They also have a venture with Canopy. And so I love this. I love this so much. And so basically, I think that cannabis is a big part of our future. And I think that the SIN stocks I talk about all the time, Altria's of the world, for example, they got the distribution figured out. They got the production figured out. They got the scale. Who's going to sell it in a responsible manner? In our current ecosystem, you basically have all these localized players. And it's really confusing because a lot of them are un-bankable, if you will. And so they take in cash, and then how do they even manage their cash? Because they can't deposit in the bank because the bank doesn't like them. Hello, on another topic, I was in the bank the other day. I had to wait 25 minutes to deposit a check. Blockchain, crypto, it is going to tear apart that banking industry. And that's where I hope COUCHE-TARD is looking at as well in blockchain technologies. But I digress. I'll put that aside. By the way, though, I'll link in the pinned comment below. Check out, I have a channel on crypto, PPC Ian Crypto. You will love it. Check it out. It is a cash flow perspective on crypto. But anyway, who has the stores at scale that is a company that is bankable and is a company that can figure it out at scale? These guys. And so, yeah, I get a little distracted thinking, hey, fuel market is a little weak. They're going to have to replace it with EV charging. It worked out in Norway. Will it work out in North America? Who knows? We shall see. But putting that aside, this whole cannabis opportunity, it could be bigger than everything else combined. And so I love, love, love that about this company. As a Thug Life investor. Let's keep going. Check it out on the screen right now. And so the next thing I want to share is they have the 5-year strategy, as I mentioned, to double. Man, I love these ambitious goals, and I think they're going to pull it off. And so with all of that, it's time to look at some numbers again. Check it out on the screen right now. This is from their annual report from their fiscal 2020 year. And I highlight basically one thing all the way at the bottom. Revenue's a little wacky, as we know, in 2020 because of fuel revenue is down, but they do have bigger margins in fuel. So let's look at just on a net earnings basis attributable to shareholders, up. 2018 was 1.670 billion. 2019, 1.8 billion. 2020, 2.3 billion. And so it's nice to see that the net earnings keep climbing. year over year over year. It's a growth company. And so with all of that, that is my review today of Couche-Tard. Let me know in the comments section below what you think about this company. Have you heard it before? Do you own it? What do you think? I think it's a really interesting company. Now, will I be buying shares? I don't know. I'm kind of on the fence of it. I'll tell you why. If I just had a bunch of money lying around right now, I'd probably go ahead and buy a starter position. The fact of the matter is I'm fully invested in stocks right now. And so I'm in the kind of position now where I also have a few stocks in the company or in the portfolio like Viatris that are smaller positions that I want to build up bigger. And so the question goes in my mind from a capital allocation standpoint, do I want to add more money to Viatris and other stocks? Or do I want to start a net new position? I'm kind of at the point now where I want to beef up a few of the existing positions a bit more like Viatris. But once I've kind of beefed them up to a better size, I'm taking a hard look at this and I think I might buy some shares, but I would buy the Class A shares. But let me know what you think in the comments below. By the way, if you enjoyed the video today, please smash the like button. It means the world to me. Also, please don't forget to subscribe with the notification bell because I have so many more videos on the way. You don't want to miss out. And if you love what you see here, join my patrons. I have a Patreon. It starts at only $3 a month. It's basically not much at all. And you get instant access to 29 videos. You get instant access to my watch list, which stocks I'm watching at any given time. And I have over 170 patrons there that are asking all kinds of questions. And so you also have access to that community and access to ask questions over there. It's a really great community and a really awesome value in my humble opinion. I will link to that in the pinned comment below and you can cancel at any time. And so try it out. Try it out. Let me know what you think. But people are giving me feedback and they love it over there on Patreon. And so I'm really excited about that. And so before I leave today, in terms of full disclosure, I do own the stocks mentioned today. I am long the following stocks. I am long McDonald's, ticker symbol MCD. I am long Cedar Fair, ticker symbol FUN. I am long Viatris, ticker symbol VTRS. I am long Altria Thug Life, ticker symbol MO. And I'm long Utz Brands Inc., ticker UTZ. Also, I may go ahead and initiate a position in Couche-Tard, and I would be buying the Class A shares, which have ticker ANCTF. And so those are the stocks I own. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's very possible to lose a lot of money in the stock market. Also, I don't provide tax advice. I'm not a licensed tax advisor. Please consult your tax professional before making any tax-related decisions. All right, everyone. Thank you for watching the video today. Don't forget to subscribe. I love you all. I will see you in the next dividend investing video.